Welcome to the Investing Podcast presented by Tusk Media. This is Outsider Trading, an audio and video deep dive into the people, places, and things that we find most interesting in the market.
Hey everybody, welcome back to the Investing Podcast presented as always by Tusk Media. This is a special week for us. I'm Andrew Hall, Ben Nye here. We are talking a lot about earnings this week. Because of that, not as many just everyday market updates.
Right.
So switching it up a little bit, we are also going to be out of town for a good chunk of this week. We're going to be at the Invest for Kids conference up in Chicago. So follow us on Twitter at Tusk Media LLC. Check that out. I think the link is actually on the video. You can see it. If you're reading this or watching this on Seeking Alpha, we got the link at the bottom of the article. So you can check that out there. But follow along because we're going to hear some really great speakers, listen to some ideas, and kind of get some coverage on that. But since we're going to be out of town for some of this week, and there's so many companies reporting earnings, we thought it'd be good and prudent for us to go ahead and just upload a bunch of content and commentary on some of the companies that we have an interest in. Some of these are companies that we own, some are not. But the first one we're going to start off with is right here, and that is Chubb, a company that we do own stock in, ticker CB. So I'll let Ben Nye kind of take it away from here and start really talking about what's going on along the way. We'll have some charts and graphs, and we can kind of get a feel for what's going on when Chubb reports earnings.
Well, I'm actually pretty excited about this because we actually did a whole pitch last week on this. We all got into a room together and talked about the stock for a couple hours, and we're going to share with you some of those same thoughts that we had at the meeting. And because we talked about it, hopefully you guys will have a little bit clearer view than we did when we first entered the room. And it was,
I'll play spoiler a little bit. It was one of those somewhat anticlimactic pitches where the takeaways were a little bit more subtle. You know, it wasn't a, hey, let's go all in on this thing, or let's totally get out. But we'll kind of frame that conversation as we go.
So Chubb, as you can see, I mean, excellent share price performance over the last number of years. And leadership on Chubb is very interesting. So Chubb is in the property and casualty space. It's an international insurer. So it's not just in North America, it's very geographically diverse. But they did, at the end of last year and the beginning of this year, they closed on the acquisition of, actually bought Chubb.
Yep.
So
Chubb bought Chubb.
Chubb bought Chubb. The actual transaction went down that ACE purchased Chubb, and then they renamed the company Chubb. The reason they did this was because ACE had a much lower customer satisfaction rating, lower customer responsiveness, lower claims responsiveness than Chubb did. So
it's kind of like if our podcast had a really bad reputation, but we bought another podcast, we might take the other podcast name.
Yes.
And that's probably really close to home as an example, except we're not acquiring anyone. But
exactly. So the leadership of formerly ACE, now Chubb, is a bit of an interesting story. It kind of runs these big New York families, almost these Godfather type families.
The mafia of insurance.
Right, the Greenbergs. So if Greenberg rings a bell to anybody, Hank Greenberg was the CEO of AIG until about 2005. And he left, he was kind of pushed out of the company by board members that he brought in. So he has two sons. Oldest is Jeff, who works at a big law firm. And the younger brother is Evan, and Evan kind of didn't really know what he was doing for the first until he really graduated, and he really had time to find himself. So he finally found himself. He got into the low level at an AIG insurance outfit in Colorado, and worked his way up, all on his own back while his father was CEO of the company.
Nothing to do with the last name.
And he became a vice president of the company, but then did not enjoy his father's kind of domineering management style. So he left the company, kind of took another year to find himself, rediscover what he really wanted to do.
He's so found at that point.
He's incredibly found. And then ACE brought him in early 2000s, and he has led the company, bought a number of other insurance companies, and kind of rolled up. And so now they were this $30 billion company that now acquired another $30 billion company in Chubb, and now he's running the whole thing. So that's kind of how we got to the point we are today. Excellent share price performance in the interim. So we now have a graph up on kind of some of the metrics that we like to look at when we look at an insurance company. We look at loss ratios. Chubb is doing really well there. We look at expense ratios, phenomenal performance. So you add those together and you get a combined ratio. Combined ratio, you actually want low. It's kind of like golf. You want low because the inverse of that, you do 100 minus the combined ratio, and that's really your margin, your underwriting margin. So when I sell insurance to you and a whole bunch of other people in your situation, my expectation is that I'm going to make $100 and pay out $87 as a whole top cost of insurance. Price to earnings ratios are relatively attractive. Price to book ratios and price to tangible book ratios are elevated. And the reason that is because of all the goodwill that's on its book now as a result of the acquisition. Excellent return on equity at Chubb. So the performance has been quite good. Mm-hmm. Some people would say it's because they have just not been very good. Like they've been low cost provider, not as extremely high touch, not extremely high quality, but they know how to run the business. So one of the things that I like to look at when big companies merge is the purchase price allocation. Mm-hmm. So what companies have to do, every quarter they have to disclose in their 10Q how they're allocating the price that they paid for an acquisition, especially a material acquisition like this. So in note 2 of the financial statements, you can go and look and see, okay, well, when they bought Chubb, how did they actually allocate that price? Because you have to have identifiable assets that you purchase. Right. And then goodwill is always the filler. Mm-hmm. So watch out, if you see goodwill rising in terms of that purchase price allocation, yeah. If they said, well, when we bought it, there was $3 billion of goodwill, and now there's $10 billion of goodwill, but we still paid the right price, we're just like, it's just a lot more synergies than we thought, that's a big red flag. $7 billion basically disappeared. Right.
And they said, well, we got to put it somewhere. That's a lot of goodwill.
Yeah. So if you watch, like, if you review Seeking Alpha articles that are big short sellers, if you look at some of the big hedge fund managers who are short sellers, this is something that they look at. It's one of the first things that they look at when they look at the financial statements, because a lot of times there's low-hanging fruit for a pretty, exciting article.
Right.
That they can write.
And kind of an easy way to think of this is, imagine you go to the grocery store, you spend $100 on stuff through the store, you get back and you're looking at your receipt, you're trying to figure out what actually you spent money on, and there's something missing. You got to come up with something really quick. Right. Oh, well, I bought a pack of gum, so I chewed all that gum. That's why you don't see it there. And maybe you say that. Well, then if you get to another house and you're missing even more, you get to a point where that's a whole lot of gum to be chewing, and it starts to make less and less sense over time. So kind of the same idea with that goodwill. It's kind of a placeholder a lot of times.
So we've had one revision so far, and it hasn't been very large. So that's a good sign for Chubb. We'll see this quarter. So the 10Q is usually released after the press release comes out. So there may be some delay in the time when they report earnings and when you can actually get that information. But take a look at the financial statements. I mean, everyone should always be reviewing the SEC filings anyway. And this is a great place where you can review something that a lot of people are looking at but may not hit the headlines of the articles that you read. So far, no red flags there, but continue to watch that going forward. Also take a look at the loss ratio by business line. This is another place where Chubb has had pretty solid performance. You can see a lot of the North American loss ratios have declined. But the question now becomes, is that changing? Because we can all look at historical results and say, okay, well, this has kind of been what has happened. But now, where can we look at what's a leading indicator to show that the loss ratios may be increasing, or what's a leading indicator that they're going to continue to decline? So when you look at loss ratios, a lot of times it's the efficacy of the underwriting and the pricing of the underwriting. So Market Scout puts out these composite property and casualty pricing data, and we can see that the pricing of property and casualty insurance has actually started to flatline, started to decline somewhat. It's coming off the top. And we can see this on a year-over-year basis. It's not actually falling off a cliff, but it's weak. And Greenberg and the rest of Chubb management would characterize it as soft. And they did last quarter. So when you review the quarter, keep an eye on to how they are characterizing the current pricing environment. If they're saying, and watch how they characterize it now versus how they characterized it previously. Sometimes you have management teams that are extremely promotional, and they might say, you know, it was very strong last quarter, and it's strong this quarter. You have to say, well,
what's the difference?
What's the difference? Yeah, you don't just believe, okay, it's strong, so that's good. You have to figure out what is the trend in terms of how they're characterizing it.
And they're very intentional in their work. They're very coached on this. You may listen to a conference call or read a transcript and think, oh, this guy's taking a question off the cuff. There are no surprises on these calls. They know what's going to be asked. They know who's going to be asking it. Management teams know top analysts that are actually getting their voices heard on these calls pretty well, and they know what they're looking for. So if they say very strong versus strong, strong is the best adjective they are able to defend.
Yeah, it's not like listening to me on the podcast, who probably every 5 words I say something that I don't.
I think you're doing a very strong job today.
Extremely. Maybe only strong though. I don't know.
It's getting strong.
So, and then Market Scout also comes out with property and casualty pricing by line, and you can also see that jumbo pricing tends to lead the rest of the accounts. So keep an eye on the jumbo and large accounts in terms of what their pricing is, because that tends to be a leading indicator for the rest of the business as a whole. One of the last pieces on Chubb is that catastrophe losses are not included in the loss ratio. This is because they want to smooth results over time and give people a better idea of what the underlying business is doing. However, if you're not reserving anything into that loss ratio for catastrophes, that 13% margin or whatever they're doing on the underwriting side is not an accurate picture of what they're actually, of their actual profitability.
Unless they're confident that catastrophes are over.
Yeah, right.
No more catastrophes.
So what's interesting to me is if you look at some of the U.S. Insurance industry data, the number of declared catastrophes is actually up this year, but the damage that these catastrophes have done in terms of monetary damage is not very large. So you're having more catastrophes,
less
catastrophe events, but in areas that just incur less damage than you would expect.
Right.
So if there's some reversion to the mean, that could hurt Chubb if if they're not adequately prepared for it. The last conference call, they did say that they're using more reinsurance, but they declined to comment on actually how much reinsurance they have. So the estimates for Chubb: $2.50 in EPS, $8.14 billion in revenue. So those are the big bogeys. Those are the headlines you're going to see. So as you've talked about, this is a street expectation, and to the extent that they can actually beat street expectations, they're doing better than expected, and people project that into the future.
And that's where kind of some of these subtleties that you've touched on would really come into play. A great example is if they beat the expectations on revenue and EPS, stock may really kind of take off, but if you can dig in there and maybe find something a little bit different in terms of where the actual purchase price is allocated and start to see some change there, you may actually see an opportunity to get out of this stock, for instance.
Right.
So that's where you kind of have to look at some of these subtleties.
Right. So we're going to be highly attuned to that. We are obviously long the stock, but we're long it with a cautious eye, I would say.
Yeah, very much so. So that was Chubb. We're going to be back really over the next couple of days with a lot of previews, so stay tuned. We're going to hit everything from Amazon to Twitter to Boeing and CCMP, all kinds of stuff. So stay tuned.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are our professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.